Okay. Well, yeah, appreciate everyone being here. Super excited. We got some really just nice, great folks on here. A lot, everyone can learn from. So, really appreciate Morgan, Jimmy, and Linda hopping on. And I guess we'll just kind of kick it off. But yeah, Hayden, is there anything else we should kind of mention before we get rolling?
Yeah, just excited to have you guys. We're seeing some interesting trends in the market, especially over the last few years, right? So we're looking for just to hear your perspectives and see what you guys are seeing. So yeah, I think it'd be best to kick it off with intros first. So Morgan, you're to my right if you wanna take it away.
Cool. Yeah. Hey guys, Morgan Keim here, coming to you from Southern California, right between LA and San Diego and Orange County. I run a company called Ocean Ridge Capital. Our focus is creating durable income and compounding wealth with real estate, particularly workforce housing being a key sort of fairway focus for us. But we also are looking at different things in the private credit and alternative asset spaces. So really just directly as a conduit to opportunities that help mainly founders diversify their wealth in a variety of ways that the stock market doesn't really let them have. So that's about me. Jimmy, do you want to go next?
Sure. Thank you, Morgan. My name is Jimmy McGrath. I run a company called Keljam Properties. We're based in Littleton, Colorado, just a suburb of Denver. And yeah, I've been in commercial real estate for, man, a long time, over 30 years, primarily as a commercial broker. And then I've been an active investor for my own account for over 20 years. And about 3 years ago, I started Keljam Properties really to help other people that weren't having access to these types of opportunities that we're all so familiar with and that have been really great vehicles to build wealth and create cash flow. And so that's my main focus is partnering with best-in-class operators, helping other professionals access these types of investments.
Awesome. Linda, if you could introduce yourself.
Yes, absolutely. Well, first of all, thank you for having me on. I really appreciate it. So thank you, Dustin. Thank you, Momentum Multifamily. So my name is Linda Holtz. I work with my husband, Connor Holtz. We run Married to Real Estate since it's husband and wife team. We're actually based out of Chicago right now, but we started the company in Houston back when we lived in Texas. So a big portion of our portfolio is in Texas. Professionally, I've been in real estate management for 11 years. We started investing for our own selves, kind of like Jimmy here, in 2020. And then over 2 years ago is when we started Married to Real Estate. So time flies when you're having fun. And yeah, our goal was really when we, funny enough, being in the property management industry, we didn't realize everything that was available to us. And once we did, our mission became to spread the word. So that's kind of how we got here. And like Morgan said, our goal is like telling people, hey, there's actually alternatives to just the stock market. So that's what we do.
Awesome. Well, appreciate everyone being on, and your time's super valuable. So just yeah, very grateful to each of you. And then I guess just to kind of kick it off, would love to hear, I guess, Linda, maybe kind of starting with you, and kind of working our way back a little bit. What asset classes are you in? And then where are you looking to allocate for this year?
Yeah, absolutely. So right now we started with a focus on value adds. Again, being in Houston at the time, really Houston, San Antonio, Dallas markets were our primary focus. And yes, always value add. So always anything that we can turn from a C into a B pretty much, whether it's market, property, or both. And along the way, we somehow got involved into different types of asset. We're actually working on a retail project. We're working on a Class A project. Um, it just worked out that way. It's funny because sometimes you look for something and then things happen. But we definitely like the model of the value add. Again, going back to our mission, for us it's two-sided, right? There's the investors and then there's the residents. And me personally, I just love the idea of taking something that's not necessarily working very well and giving a better housing option for residents. So that's pretty much what we look for.
Awesome. Yeah, and I love the fact that you have that background in property management, and so I'm sure that helps a lot when you're looking at deals and evaluating potential partners and all that. But yeah, Jimmy, would love to hear what asset classes you're in and just kind of what your focus is maybe for this year.
Sure, happy to do that, Dustin. Appreciate it. Historically, I've been mostly in multifamily. It's kind of funny because as a broker, I was in office space, and I think I probably just knew too much in office, and I know people and companies have made money in office, but I just vowed I would never invest in office space, and I've held true to that for the most part. So I have been, as a broad class, primarily in multifamily, leading up, really all the way through 2021. We think we're all aware of what happened in 2022 and how that's impacted the marketplace. I have done two multifamily deals since then. One was in Greenville, South Carolina, which was a value add. One was in a suburb of Phoenix, Arizona, which not really a value add, but not a brand new product either. But both really good, solid markets, good labor, good demographics, good price point. So I like multifamily a lot. I think, there's obviously you got to be careful with it right now for a lot of reasons, which I'm sure we're going to get into here. The other space I'm working on, and I've been working on for about a year, is a fund that's called Health Wealth Capital. And that fund is investing into triple net lease medical office buildings that are primarily leased by dentists, veterinary clinics, some urgent care, but it's all medical related. It's all long-term triple net leases. And I really like that asset class for a variety of reasons. So that's kind of what I have my hands into right now.
Awesome. Yeah, sounds great. Just interesting commentary for you if you're office broker and you stay away from it. So
I think I just know too much.
yeah. Sounds good. Morgan, I would love to kind of hear what you're up to and what this year maybe looks like for you.
Yeah, I mean, for me, I'm basing a lot of my lens today on 13 years of passive investing, which I started in multifamily when I previously was running companies in a venture-backed tech space, so totally different. And I had done 15 or so LP deals before I ever raised capital into anything. My breed was originally LA workforce housing, which is a very specific kind of almost litigious type of play. It's very, very different than what we look at nationally. But one of the things that it kind of led me into the lens that I carry into how we invest today when we're looking at multifamily, mobile home park opportunities, and the other things in real estate adjacency, it's kind of a deeply contrarian approach right now. I think a lot of people are over indexing on the demand story and under indexing on supply. And you see this. There's a great book called Capital Returns by this guy, Edward Chancellor, who goes through about 15 years of his financial firm reports and shows how this is like kind of the case in every industry. But anyway, we've seen kind of this oversupply in a lot of Sunbelt markets. We've seen obviously what's happened with rates in the last several years. So our approach is a little more around looking for supply constrained markets, assets that are trading at a really substantial cost to what it would be to build them today. But where there's still enough demand, it's just that supply wasn't overshot. Now, that could very well change in the coming years. But today, I like that play a lot. And I like that in terms of the assets that we're typically looking to invest in, which is Class B, multifamily, it's mobile home parks. And then it's adjacencies in the private credit space that also kind of identify those key, bottleneck constraints where maybe they just weren't the fundamental a la carte play the last couple of years, but the dislocation is actually creating opportunity today. So we're looking at a lot of things in there, as well as we build into alternative assets. Same kind of approach. Where is it that banks aren't really looking? Things are a little too niche. Mainstream investors haven't yet realized the potential, and there's asymmetric returns relative to the risk that we're taking. That's kind of my defining lens today.
Yeah, I think that makes a lot of sense. We're seeing a lot of that going on in the market, and you kind of have to during distressed times, right? Morgan, I'm gonna stick with you for this next question too. You know, looking at diving into the underwriting for an opportunity that you're looking at, what are you paying particular attention to, and maybe how has that changed over the last few years?
Yeah, I mean, similar to, what I mentioned on the supply constraint, I'm actually really indexing markets heavily on supply and demand, and I'm looking to see what the pipeline looks like of A, like absorption, B, of what's coming, and C, what is it likely to be, 2, 3, 4 years out from now. I think that really weighs heavily. We're heavily scrutinizing debt and cost of basis as being really key metrics. We as operators have a good amount of experience in the workforce housing sector, but I've built my platform to be more focused now as a capital allocator. So we're backing operators like Momentum and others to basically, have the pattern recognition of understanding what things are like on the ground. So, there's heavy scrutiny on understanding how management is going to be, what kind of processes exist. And I'm really looking a lot for not just finger in the wind type answers, but for repeatability. I want season tickets with great operators, and I love to go deep rather than wide. So that's a really key, fundamental thing. Of course, the basics have to check out. And I think the number one deal killer that I've seen in the last 12 months of all the multifamily and mobile home park opportunities, the number one thing has been pro forma year one rents relative to market comps. I've seen so many deals that say 5% rent increase upon buying where I can't find the comps to justify that. And because real estate trades at a value of net operating income over the basically the market rate, if you can't justify that, you fundamentally underscored the value that the deal is going to be lower than what's projected. I'm out, right? So that's a really, really key, easy kind of 2-minute fix. But a lot of people I notice don't do the work on that. So that's been a big one for us.
Yeah, that's great, especially on the supply front, just because it's been such a headwind over the last few years, right?
Yeah.
Linda, I'm going to bounce the same question to you. So, what are you looking at on opportunities, particular in the underwriting? Maybe our red flags, maybe some green flags too.
Oh, I like the idea of adding the green flags in. So I'm going to, if that's okay, step away a little bit from the numbers, like the pure underwriting of the deal. And my answer is going to be, we've done a couple of deals kind of like through connections, like, through networking, and it just so happened that because of that, those were not always connected to one another. And so because of that, now we're very much focused on kind of like what Morgan said, hey, let's go deep instead of wide. Like from now on, let's really know who are the people that we want to partner with. I mean, it's kind of funny because I was just talking to somebody who's working with Aaron this morning, and now he's here on this panel and putting a message in the chat. But yeah, that person was just telling me like, hey, we want to be very careful who we do business with moving forward. And I know these guys, and they're very good at what they do, but sometimes the loudest teams are not always like the best teams out there, sorry, are not always the loudest. And so that's kind of what we're looking for at this point, is not so much deals but teams to partner with, and operators that we feel know what they're doing, that we feel are scaling but not too fast, and are doubling down on what they know how to do already. Why do they know how to what they know how to do? Is it because of experience? Is it because they have a certain expertise? Like, this is really what we're looking for first and foremost before even underwriting a deal at this point. And then, of course, because we like Texas, insurance, I still have to say that. I know it was worse a couple years back, but I'm not entirely convinced that we're completely out of the woods just yet.
Oh yeah, absolutely. Yeah, we stay away from the coastal stuff just for that reason. But Yeah, it's interesting. Starting to see a theme here, with the operator, the team, right? That's so important. And we've got such a great case study to look back over really since the pandemic, 2020, right? Past 5, 6 years have been interesting to navigate. And so how people navigated that is really interesting and valuable information. Um, Jimmy, I'm going to toss the same question over to you.
Thanks, Hayden. And I'm going to really echo a lot of what Morgan and Linda just said. I think for me, there's a number of key factors, and I think probably the biggest for me is the operator. And I want to know that the operator's experienced. I want to know that they've lived through at least one down cycle, if not two. I want to know that they're focused on a market. Um, I really like operators that say, I work in Greenville, South Carolina. That's my market. I know everything that happens here. Um, and pick any other market, but that profile I really, really like, as opposed to someone that says, well, I'm going to go to Jacksonville today and then I'm going to be in Atlanta next week and we'll figure it out. So that's kind of step one for me. Obviously, the markets are important. I agree a lot with what Morgan said about supply. I live in Denver, which is one of the most oversupplied markets, and I've watched it happen. And interestingly enough, they were building all this supply based on demand that was happening 5 years ago, and that demand's not here anymore. So it's a double-edged sword. Um, so that's a key piece. Maybe a weird thing to say, but the political leanings of the state are important to me. I want to be in a state that's landlord friendly, and financing is big. And I'm kind of trying to go down this in order of importance to me. I think financing is huge. I want to see fixed rate debt. I want to see really a minimum of 30, if not 35% equity. And then you've got to look at all the assumptions, obviously, around current rents, rent growth, vacancy percentages, CapEx, doing your due diligence around the building and what the CapEx budget is and what has to be done is a big one as well. So, yeah, so those are kind of the things I'm looking at.
Yeah. Yeah, it's great. Yeah, I yeah, very much agree with you. Instead of oh, I'm flying to Atlanta, I'm flying to Tampa, blah blah. Oh, I might know a guy there that can help out, boots on the ground. So anyways, but yeah, definitely yeah, great feedback there. Um and then I guess just Jimmy, kind of going back to you, I guess is there anything that there's the theme between the three of you is it's been kind of been team and all that. So maybe might be repeating a little bit of what was just said, but is there anything that I guess you would kind of change moving forward? Just kind of looking back in the rearview mirror of, maybe some deals or people you've worked with or whatever. Any kind of changes for you kind of moving forward?
Are you talking specifically about the operators that I want to partner with?
Operators, asset classes, age of deals. Obviously
Well,
it sounds like you said fixed rate debt. So I'm sure, that's
yeah, that's a big one for me. I mean, the
yeah.
operators, I think, and I've made some mistakes over my years as an investor where, I kind of believed everything that they were telling me. And people can tell a really good story and they can be very convincing. And in some level, all of us are in sales and
Mm-hmm.
good salespeople can sell. And so I have changed this, but I'm going to continue to make sure I do really good due diligence and background checks on the sponsors and the operators. Um, Sorry, you asked me one other thing and it kind of just slipped my mind as I was going through that answer about what I was, quality of product and that type of thing. I feel like a lot of
Yeah.
times people, and me in particular, you'd say, well, anything after the 80s was fine. Now I almost feel like it's anything after the 90s. And I don't really like the real new stuff because I feel like it's the unit sizes have gone way down. And it's one of the things that developers have done to try to make the economics work is they create smaller units to somehow or another have their per square foot price still work out. But if you're a renter, you care about the size of the unit. So I think there's a sweet spot in there of kind of early 90s where it's new enough. It's probably well located. And the unit sizes and the buildings are they're just spacious and they're just roomier. And I think it's a better experience for the renter. So those are a couple of things that I've modified over the last couple of years.
Yeah, yeah. We've it's funny. Hayden and I have talked about that quite a bit recently, just how the newer product feels like it's shrinking a little bit. Yeah, there are some, some nicer, some different, bells and whistles, amenities and all that. But, at the end of the day, a lot of the units have shrunk for sure, it seems like. So, yeah, it definitely noted there. I guess Morgan, kind of going over to you, same question, anything that, you've been doing this, as an LP, long time, and then, operator and all that, anything you would kind of, change or lessons learned and kind of moving forward?
Yeah, I mean, I could write a 1,000-page book probably on the lessons learned in the last 13 years, but I'll focus it to the last 4 or 5 because those are the substantial ones. I think the two things that really stand out to me, one is knowing where you're going and why you're going there. Whether you're a fund manager like I am and you're a direct conduit to your investors' needs, or whether you're an LP and you just have certain goals. You have to are you after passive cash flow to replace your income? Are you after tax efficiency that year? Are you compounding wealth for your family, for your kids? The mistakes that I've made in the past, they generally weren't like I did this floating rate debt deal that came crashing down. We largely avoided that. I kind of saw the writing on the wall in 2020 and 21. We didn't partake in those. But a couple of the deals that I did personally, like as a passive investor at that time, were because I had a windfall of cash from other sales. And I was scrambling to put it to work before inflation eroded it to peanuts. That's kind of a bad pattern heuristic. And because of that, it eroded my thinking at that time to put some development deals in work when that's not really in my buy box. And I'm not really an equity compound person. I'm more of a passive cash flow person. So like it was the awareness of realizing like, what is it I actually want out of the experience? And what is it that my investors want out of this experience? That's how I want to spend my time. That's something I carry with me today. The other big perspective that I had, and we've seen we're, in the process of seeing this, this wall of maturities, particularly in the multifamily side, and some sponsors are losing assets. And so I really, like back to what Jimmy and Linda said on the team being such a key part of the investment thesis today. If I could rewind the clock 5 years, I wouldn't have gone just with the enterprise sponsor with 25 billion under management. I'd actually, if anything, side with maybe one that had lost capital on a deal or two, but had gone through it and figured it out and just did the thing they needed to do. Because I actually watched some hands fold from people that had enormous portfolios, but actually claimed, I've never lost capital on a deal because they'd never really struggled on a deal. Now I value people that have actually gone through the struggle and they get what they're going into and they're still in it because they're going to carry that pattern recognition into the future and say, we know how to drive this thing forward when the shit gets really ugly. That's actually more valuable to me than the claim I've never lost a dollar of capital. So that's kind of a key thing that I look for these days.
Awesome. Yeah, that's a great point. I guess I hadn't really thought about it from that perspective. So that's, yeah, super interesting. Or if they have such a large portfolio and they have so much, so many issues, it's, just kind of overwhelming, and they get overwhelmed. So there's a few of that, a little bit of that in the real deal for everybody. So, Linda, so for you, anything that you would change, or just kind of just kind of lessons learned in the past and kind of moving forward, maybe some changes. I know you kind of mentioned team and all that too, but I wasn't sure if there was anything else.
Yeah, I think I'm definitely with Jimmy on the trust but verify. I have the benefit and the how can I say that, the backing of working with my husband, and I can look at the world and people with very rose-colored glasses, which is why I don't work by myself. I have somebody to tell me like, hey, maybe take a step back and actually feel people, right? And actually like read between the lines and all that. So for me, that's my husband doing that. And I think that a lot of times we hear a very good story and we're tempted to believe it. And it's great to want to believe in the good of the world, but yeah, trust but verify. Always make sure, it goes back to the team. And I don't want to sound like a broken record, but that is the number one lesson that I've learned over my years, is that it's more important to deal with the right people than work on the right project. It almost doesn't matter to me at this point of my journey what the deal is, what the market is. Of course, those are like, they matter, but they're secondary. The first question is, who is doing it? Who is running the project? And when I say who is running the project, that's what I mean, is who is running the project. I think we have seen a lot, especially very lately, um, from our industry, from people who, you know, different people disclose different things, but it's like, okay, but what I want to know is the people who are actually going to be on the ground, the people who are actually going to run the asset, who are actually going to make sure that this business plan is followed, who are actually going to follow up, make sure that like the on-site team is not stealing or is taking care of the residents correctly or taking care of the employees correctly. They're part of the community too, right? When you buy an asset, and it doesn't matter what type of asset. It doesn't matter if it's a commercial deal, like a retail deal, I mean, or if it's multifamily, or if it's industrial. There are people involved in all aspects of the project where I'm like, who are the people in charge of those other people? That's what I want to know. And that's really what I would say is trust but verify, because we can all believe a beautiful story. We all want to believe a beautiful story, but it's like, who are you in this project? Like, what is your role in it? And if I understand your role and I'm okay with what you're doing, that's great. But if your role is not to oversee all that, then I want to know more about who is actually going to take care of my investment and my investors' investment. And also going back to what Morgan said about goals, I think that's very important, because one of my favorite things about real estate is that there's a little bit for everybody. So don't get on deals or opportunities just because they sound sexy or it's the only one right now. Because I mean, how many deals were closed in 2023, 2024 compared to the 2 years before? It was like slim pickings out there for a while. And it was like when you had a deal, it was like, oh my gosh, I have to invest in this one because I might not have another one for like several months. And it's like, but what if it's completely misaligned with what you're trying to achieve? These are 3, 5, 7 year project that you're going to be on, that you're going to have to, if you're part of the team, be on calls every week, every couple of weeks, all that. And so for me, it's more important at that point to realize, is this aligned with what we want to achieve long term? I mean, there's definitely a couple of deals that I'm on right now where I'm like, it's going great and I love it. But because of where I want to focus, I will not do that next time. Nothing against this deal, nothing against this team. Is just not aligned with what we want to do long term. And if I had to do it again, I just wouldn't do it. And I like what Jimmy said about the age, because me being from Europe, I get the whole, after 1976 thing, but also the older the better in my book, because I know it was built to last.
That's so true. Yeah, and I love, the name of your company, Married to Real Estate, because it's so true, right? You're married to these deals, you're married to your partners, you're married to your investors. So you got to choose wisely, right? Um, I'm curious. I'll stick with you, Linda, because this is a question that's been, it's not something that's top of mind, but we're starting to see opportunities that look pretty interesting. But it's kind of turned into, what goes along with it is, I'm going to call it a six-letter word, right? It's a bridge loan. Nobody wants bridge loans. And I know some of you guys have already touched on fixed rate debt. But there's a lot of deals out there too that are highly distressed, from people that had a distressed capital stack, or maybe distressed operations. And some of these aren't stabilized. They require bridge loans, but at some attractive basis too. So I'm curious because, we're wondering the same question, to be honest. When does appetite return for some of that stuff? Does it have to just get cheap enough to make it make sense? For not only you or your investors too, because I think that's a whole nother conversation, along with the question of when does it make sense, or would you ever do a bridge loan again?
Right now, no. But here's what I will say. Here's what my answer is, big picture. I think it really goes back to the personality. Would I look at it? I might, but if I look at it, I may not necessarily present it to all of my investors because I know who has the risk tolerance or doesn't, right? And I might even say, hey, this is above my risk tolerance, but just so you know, this came across my desk to somebody who I know is more inclined to want to do it. Like, it's not always for us. We really view helping investors as, I'm going to help you. It doesn't matter if it benefits me or not. If there's something that I think you should look at and it has nothing to do with what I'm working on, then yeah, I'm going to send it to you. So going back to the bridge loan as an example, it's like, hey, if you are less risk adverse that I am, like if you're more willing to get out there, or for whatever reason, maybe it's you're in different season of your life, maybe you're in different season of your income streams, whatever it is, where you might be more willing to do it, yeah, I'll send it to you. It doesn't mean that I might invest in it. It just means that I just know your personality, what you're looking for. Again, going back to like, are your goals aligned with what this project is doing? I'm also a big believer that our goal is to help, assist, and educate. At the end of the day, we're adults. And it's like everybody has to make the decision for themselves, right? And that's why I'm like, for me right now, June 2026, no, I would not do a bridge loan. Probably
Gotcha.
for a few more months, if not years.
Yeah, yeah, no, that's a great perspective too on everybody has their own risk appetite, right? I know some people that, as operators, that's all they want is the hairy deal that is highly distressed, right? And they want to come in and turn it around, right? And same thing with investors, but similar for us, we're kind of seeing just better opportunities out there than chasing, we'd rather chase a distressed capital stack right now than a distressed deal. So yeah, I'm curious. I'll go over to you, Morgan, what you're seeing, feeling, hearing maybe from your investors too.
Yeah, I mean, my philosophy on this whole paradigm of any type of investing is protect capital at all costs first before compounding it. And if you look at the people that do this role well, they tend to not be the people that get the highest absolute return. They're like the type of people that kind of meet the return of the market with like a lot less risk, right? And that's how I see this kind of thing. So would I do a deal with a bridge loan? Possibly, but it would be counting against the asset, and I would even rank it as a conditional. We send a scorecard out on every deal to our investors, and it's like the good, the bad, the ugly. This is a B plus. Here's why it's a B plus. This is what sucks about this deal. This is what's great about this deal. This is where the risk is. This is not right for you if you're this type of investor. I want that level of transparency because a lot of people are coming out of this, this, Dustin, you called it when we talked last time on the phone, the trust recession against sponsors because of this whole floating bridge rate stuff and market conditions not being what were underwritten in the last several years. We need to build back trust. And the way I see that happening is through really immense transparency. And not only that, like stepping forward and showing exactly what the ugliest parts of the deal are so that people know exactly what they're getting into. And so this deal is out for me, but it would certainly count against it and it would be called out in flashing letters. And then I'd have to say, look, here's why we still will do this deal. And it has to be overwhelmingly clear that we understand the asymmetry in the reward is worth taking that additional risk. I would also be looking in this case around market selection. I would be less likely to do a bridge loan in a supply expanded market because I'm less confident in the business plan. I would rather do a bridge loan in somewhere that has not had a lot of building done and it's being acquired from the less sophisticated operator that wasn't able to do the value add and lease it up. That's a little bit less risky to me. And that would be something that I could stand and qualify on. So unless the basis was absolutely absurd and there were some really, really key things that maybe made the case for it being in a supply heavy market, I would tend to shy away from those until I see the bottom in a little bit on absorption of supply.
Yeah, makes sense. I'm kind of hearing too a similar theme of, that story is just really important. And that's what, Dustin and I talk about this a lot, especially for investors, because if the story's not there, they're going to find a better opportunity out there where it is. You have the complete picture because, there's just too much opportunity out there right now too. So just a whole nother variable to consider um, when looking at different opportunities. So Jimmy, I'm going to toss the same question over to you.
Thank you, Hayden. I mean, I think my thoughts are pretty similar. I'm gonna just take a half a step back. You know, I think about cycles a lot. Um, I, for better or for worse, have now lived through three of them. And, some of them, the first one I kind of watched. The second two, I was in it and I was in the thick of it. The one around 2007, 8, 9, I lost a lot of my own money and I lost a lot of investors' money. So I felt that pain firsthand. And I think a lot of this stuff with bridge debt and value add and distress, by the way, I like the way that you framed it in that I'd way rather look at capital stack distress than just asset distress. I feel like in some ways, the big value add deals are better off kind of in the middle to the end of the cycle when that's really the way that you're going to create returns. Now, I feel like we are, arguably at the beginning of another cycle. We might not be quite there yet, but we're pretty close. And for me, I don't want to take that kind of risk right now. I feel like there's enough opportunities out there where you've got good quality assets that are in good markets and good locations that just got screwed up on the debt side.
Mm-hmm.
And, if you can buy that at a discount and maybe you can negotiate something with the lender on the project to get some type of favorable debt going in, maybe you can raise some additional capital to cover all the CapEx. That's what I like. I think that to do the stretch on the big value add right now with risky bridge debt, that's not for me.
Yeah. Yeah, we totally agree. I mean, there's so many opportunities out there right now. Just if you're weighing, we kind of see every time you do a deal. I mean, it's a lot of work. I mean, we kind of associate like, do we want to run that marathon? And so, it's a lot of work. And so if we're going to get into something, like, we want, want it to be, kind of worthwhile and all that. And so for us, there's, some attractive deals where, like you mentioned, it's just capital stack issue. The deal's running well. You're buying at a great cap rate, and, they already spent a bunch of CapEx money. So we like that story quite a bit. A lot of those are, really well located too. And I like what you said, Jimmy. Just right now, we would have, frankly, a tough time buying in some of the areas that we're looking at right now. When the market heats up a little bit, we won't be able to touch those because the values are probably going to be too high. So, yeah, great, lots of great thoughts there. We have a number of fund managers kind of in the audience, and then we have a bunch that will most likely end up watching this and all that. If you guys were, a lot of those folks are newer. If you're kind of starting, I guess, just thinking about if you were to start from square one and to build up your capital raising business, Jimmy, I guess Jimmy, I'll kind of start with you. What would that look like today? How would you kind of get that going? A lot of a lot of fund managers, if you just kind of think about their perspective, they'll listen to this and they'll listen to other people on stages like, oh, I raised 10 million last year, I raised whatever, millions of dollars per year. And that's, if you're just starting out, that's a pretty daunting number. And obviously, like we'll stick with the running analogy. If you've never run before and you go out and run, running that marathon is going to be a real challenge. But just what does that kind of look like in your mind for getting started for folks?
Oh, that's a great question. I mean, I always encourage people to, take a risk and start things and do things new and grow and push themselves. I mean, I think that's generally a really good thing. But so much of this business comes down to experience. And, there's only one way to get experience, and that's by doing it. And so for me, I would rather see somebody before they just start going out and raising capital. I'd rather see them figure out how to work on an asset, maybe, have a role where they're doing some of the work and and maybe they're doing it as a limited partner investor only, but they have access to see, the asset management calls, they get to see the financial reports, they get to see everything. Because all this, it's very easy, especially with social media today, everybody makes it look easy. And, and in 2020 and 2021, it kind of was easy. Like anybody was making money. And I don't think that was necessarily great for the industry, but it happened. And that's what a lot of people's perspective is, especially people that are newer in the business. So I'm a huge proponent for getting in, rolling your sleeves up, really learning how these assets work, how these deals are financed, what drives NOI, what drives cap rates, what drives values, on and on and on. So, I'm hoping that answered the question, but that's my thought around that.
No, yeah, no, I think that's great. Yeah, I mean, it's you're dealing with a lot of other people's money. I mean, that's a huge. I remember when I first raised money for the first time. I mean, that's a, at least for me, it felt like a big weight, on my shoulders, and it was, a lot of money, and so a lot of people, takes long. I mean, we're talking at least $50,000, usually, per investment. So, Linda, I'll kind of,
Hey, Dustin, I'm sorry to interrupt you, but I want to
yeah,
just kind of amplify what you just said because, as I may have mentioned, I mean, I had an experience where lost, I lost some friends, and it's a big, big responsibility when you're a steward for other people's capital. And I just don't know that a lot of newer fund managers appreciate that. And I don't mean that with any disrespect at all, but I can just tell you from personal experience, losing other people's money will haunt you. And it's a big, big responsibility. So I just kind of wanted to amplify what you said. Didn't mean to steal your thunder there.
no, 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 that's perfect. Great. Linda, we'll turn the same question over to you.
All right, I have to look at the time because I feel like we could have a whole other hour of talking just about this question, and I'm gonna have to control myself here. The first thing I would say, there's so many things I would like to say, but the first thing I would say is slow and steady wins the race. And I think a lot of new people, at least in my case, I came out of a mastermind. A lot of people have like a coach or somebody who introduces them to it, and like Jimmy said, tells them some level, some version of it will be easy or it will be fast or both. And I don't think either is true, or at least not as much as what people expect. I mean, I will always remember my first, I think I had been doing that for like maybe 90 days or something like that. I went to a conference and I ran into a gentleman, and I always remember him telling me, "Oh yeah, I decided to get into this with my son, and my son is in his early 20s and I have a full-time job." And when he got bored of it after 2, 3 months, it became my responsibility to, keep the ball rolling with my full-time job. And I'm realizing that I really don't want to do that. And I think that this is the trap that certain people get into is, do you really want to do this? Do you want to do it as good as well, sorry, and as long as it needs to be done for? Because if you do, it will take a very long time. It will keep you up at night if you're doing it right, right? It will be a lot of work, but at the same time, it will also not necessarily, you will not necessarily reap the benefits as quickly based on the amount of work that you're doing the first couple of years. Are you willing to do that? Are you willing to do work on this for years without necessarily making a lot of money, but just helping people and sitting tight and hoping for the best, but then at the same time also controlling what you can control? And that's also a big responsibility and a lot of pressure to be responsible for several small businesses. At the end of the day, that's what an asset is. And yeah, I think looking back, and I came from a property management world, so I came thinking, oh, I know how to take care of buildings. This is what I do. This is what I get paid to do. Um, but looking back, I'm not saying I wouldn't have done it. I would have asked myself twice what will my first year look like? Because I thought, oh, I'm going to come in and in 6 months I'll have 5 buildings and I'll retire in Punta Cana and it will be amazing. And guess what? I'm not in Punta Cana yet. And I think that this is the difficult part, is that we see a lot of things on social media. We hear a lot of things when we go to conferences and events, and it is a very good, at least in my views, investment options. Like it is a very good space to be in. I really believe in multifamily. I want to do it for years to come, but you have to understand what you're getting into. I think that's the biggest thing when you're new is, do you realize everything that it encompasses? And if you do and you love it, it's a great ride. But there's going to be bad days. Are you ready for the bad days?
Awesome. And then I guess Morgan, same question for you.
Yeah, I mean, I think this is such a good question, what you asked. And you noticed that it was kind of a tactical question, but a lot of the answers were mindset answers, right? So like I'll answer in a couple different ways because I think that's the right way to approach it. Tactically speaking, if you're starting out as a capital raiser or fund manager, you're really kind of just doing like two things. It's just you're finding deals and you're raising capital. I mean, there's a lot of things in between it. I don't mean to oversimplify things, but you have a couple primary goals, right? On the raising capital side, well, you're going to need to figure out your sources, right? There's a great book that sort of helped me get going by Hunter Thompson, Raising Capital for Real Estate. A lot of us have read that one. Lots of other resources on the topic. A lot of the initial capital, I think about it as being on the valley, kind of beyond the valley of cringe, where you have to reach out to people you haven't talked to in 10 or 20 years and reach out to 100 people. And they're like, wow, I haven't talked to you since college. What's up? And you eventually kind of are like, hey, tell me a little about your life situation. And, is there some alignment? Anyway, that's kind of like a necessary evil, I believe, in building your initial investor base. And when I had to go through that, I remember actually leaving most of that, like the first couple calls were kind of cringy probably, but leaving that towards the end and going, wow, I actually just reconnected with somebody I haven't talked to in 20 years and sort of just maintained a friendship and actually think I helped them a little bit. And it sort of became like a good thing that I actually valued and they valued. So that's something I feel like you have to get through on the capital side. On the deal side, I mean, you have to look at credibility and people, that know what they're doing. I would advocate highly, like, Dustin and Hayden, and these guys are great sponsors, other great sponsors who have real track records. That's going to be key to align and listen and ask questions and really vet who you're going to be working with than someone who's maybe just starting out. And, Jimmy said it, but play with your own capital to learn, right? Be the LP that asks a ton of questions. Go to the property, like treat it as if it's like your fund, even if it might just be a passive investment. It could be your first one. That's really key. And those are all tactical, right? But when it comes to the mindset side, I spend a lot of time thinking, what's my right to win here? What's my right to win to bring this investment to somebody else? Am I'm like not like a confidence thing, but like, am I confident? Like, do I know this thing backwards and forwards and every way through that I understand the risks to a T, that I could articulate in 2 sentences what the key primary risk factors are in this deal and whether it would be right for that person? Because I feel like I have a fiduciary duty to protect their capital, right? That's a really key one. Protection and your reputation in this business over making a quick buck, right? The Punta Cana place will come, but it's going to be working for it. It's not going to be your first year after you take a bunch of money and then you run. You're signing up for a responsibility to protect investors' capital and grow it. And that is a heavy weight, as Jimmy and Linda said. It's a very, very heavy weight. So have a right to do it. Convince yourself you're going to be there, even if this thing goes totally south and goes the wrong way. You're going to have transparent communication through the process. No one's going to ever be wondering about the status of their investment. You're going to be doing everything you can to protect it. Like that's a bare minimum necessity to I think being in that role.
Yeah, I think you made some really great points there, and specifically, I want to just echo that because I hear this with a lot of new capital raisers, right? They're scared to ask for those investments because they feel like they're just asking for something from the investors, but they need to have that paradigm shift that you're offering them an opportunity, right? So I think that change in mindset really helps. And real quick, I want to leave a little bit of time for some Q&A, but I've got one final question for each of you guys. I'll stick with you, Morgan. And normally I ask, what does your next 5 years look like? But so much has happened in the last 5 years, right? So really, what does your outlook look like over the next year or two?
Yeah, at this point, I've heard very heavily from my investor group that they're looking for cash flowing investments with reasonable tax advantage and some level of compounding as well in the background. And so we're looking at opportunities within real estate that kind of fit that profile. But we're also looking at opportunities in private credit and other areas to essentially act as an extension of, our own ability to source and vet and understand how we can be a direct conduit to a future state of our investors, right? 2 years from now, I think we, as Ocean Ridge, show up with a menu of items that include real estate as a core theme, but also have a number of other areas that are probably a little bit lesser discovered, but that offer the same types of freedom essentially that we're trying to bring from passive cash flow, tax efficiency, and compounding wealth, right? So it's a little bit high level, but that's what I'd say we're continuing to build towards every day.
Awesome. Yeah, I appreciate you sharing. How about you, Jimmy?
Just had to get my mute off. Sorry about that. I think that right now we are in a really interesting time. I mean, I talked a little bit about cycles before, and I do believe that we're in the beginning of another cycle here. And I feel like when you can invest in a good quality offering in an environment like today, in 3, 4, or 5 years down the road, you're going to be really, really happy. And I'm excited for that. Now, having said that, that's obviously does not mean that every opportunity you look at is a good one. I think we all know that. So for where I'll be in 2 years, what am I looking at today? Like I'm trying to build those opportunities up, both for myself personally and for my investors to say, and I think Morgan, you hit on this a little bit too about the difference between building equity and accumulating equity versus creating cash flow. And there's a balance, and that balance changes really as you go through your journey of life. I mean, I know for me personally, I'm way more interested in cash flow today. 10 years ago, I was way more interested in just building equity. And so that's a matter of just understanding your investors. But I'm excited about the opportunities we have right now. And I feel like, I'll still be doing this in another year and another 2 years. We'll see if I'm still acquiring stuff in 3 or 4 years, but I'm super excited about the opportunity we have in front of us right now and for the next year or two.
Awesome. Yeah, we agree. How about you, Linda?
So I might say something a little more controversial, but I think that at least for the next few months, hopefully not a year to 2 years, but at least for the next few months, I'm okay at this time, sorry, waiting and watching, if that makes sense. Just for a few months. I think a lot of people, the good old saying, a lot of people overestimate what they can do in a year, but they underestimate what they can do in 5 years, right? And so we have a tendency to think like, oh, in 5, 10 years, this is how big the picture is going to be. And so because of that, I love what you're asking about, like, hey, how about right now? And so for me right now, I'm all about capital preservation. And so because of that and everything that's going on, I'm a little bit on the side of, hey, let's see what happens, this summer, this fall. And it doesn't mean we're not actively looking for deals. It just means that we're looking at them twice before actually making a move, at least for the immediate future.
Sounds good. I'm not sure. There's one, or it looks like maybe one question in the chat. I don't know if any of you guys want to tackle it, or we're happy to. The question is investing 50K into a multi-unit in the Dallas area a good investment? How will I know? What questions should I ask? obviously there's a lot of directions you can go in, but yeah, if anyone has any advice, we're happy to tackle that. So
That kind of seems like a softball for you there, Dustin.
Wonder if anyone had any deals there.
Yeah. If anybody on the panel wants to address it, or we can, either way, but uh, Kimberly, a bunch of things that you heard on the panel. There was very much an aversion away from floating rate debt or bridge loans, and so fixed rate debt was and we would agree too would be the consensus, something to look at. I'd probably, there was also very much a consensus on looking at the sponsor, looking at the team. So I would, very, very much, look into both of those. Something that we really, look at whenever we're evaluating a deal, is we really pay attention, very close attention to the area, because you can put a bunch of money into the property, but if your neighbors, are letting whoever in, or if there's crime in the area, or just, whatever, or sometimes the area is great, but the actual location, no one can actually find the property because it's kind of hidden back. We've seen that multiple times. In general, you look at a Google map and it looks fine, but then when you either drive it, or if you kind of drive it, using Google Maps, then you're like, how do you even find this property? So those are just, a few things, that, just kind of understanding their experience, and understanding the team. And I think, multiple people had, said focusing on, who that operator is. I know Linda in particular was honing in on that, like, who's actually the operator, not someone that just, gets some of the reports, but, who's actually operating and what that looks like. So I would definitely kind of dig in there, but don't know if there's anyone else that has anything else to add, in addition to that for Kimberly.
Yeah, maybe just spun a different way. I don't know if the panelists maybe have some of those general questions that an investor should ask when they're evaluating a deal. So maybe Jimmy, if you've got any that you would recommend to an investor, when they go to that sponsor, looking at a prospective deal.
Sure, happy to take a stab at that, Hayden. I mean, I think what we've all talked a lot about really is the importance of the sponsor. And I think it was Morgan that mentioned this about almost being more attracted to someone that's been through a hard time and survived it and come through it and has the battle scars to show for it. So I would spend a lot of time asking those questions. I would ask about deals that have gone bad. I would ask about situations they've been in that didn't work out. All the 30% IRR stuff that you see, it's all just eye candy. Yes, it happens. It does happen. But a lot of it's eye candy. And so I would want to know a lot about problems that they've had and how they've solved them. And then obviously the strength of the team. And then, go even deeper about the asset level, where it is, the quality of it, CapEx. I mean, there's actually quite a few things when you start peeling back the onion of what you should be asking as an investor.
Yeah, and I'll just add to that. I agree with everything you're sharing, Jimmy, and also what you said, Dustin. Like, I really want to think about the rent and the sale comps of the assets nearby, because if you're if you're like priced way higher than anything near there, or if the pro forma that the sponsor is presenting is not in line with what you can actually find on apartments.com and on Zillow for comparable stuff, that's a pretty big yellow flag, if not a red flag, and that could kill the deal completely. We see that a lot. So it's really a gut check on the discipline of the underwriting, because I mean, how you do something is how you do everything. And if you're actually saying, hey, this is pretty fair, if not a little conservative for the market, that's a green flag, right? Now that actually might say everything might be a little bit conservative. Go deeper. But those are some of the signals we look for, when we're evaluating those kind of things.
Yeah, and I know we're at time, but one important thing that I wanted to say on the cusp of time is don't be afraid to ask for help. Every question that you ask of the operator, analyze the answer for yourself. And if you're not sure what it means, go ask someone else. I mean, for me, I'm always saying like, hey, anything that you're going through, if you're not sure whether it's a good thing or a bad thing, come ask me. And if I don't know, I'll refer you to someone else who has more experience. So if, for example, taking back what Morgan said, because I agree that like projections are just projections, but ask what are they based on? And then if you don't know how to analyze that, go ask someone else. Hey, what does that mean? Like what kind of, if they're telling me that the market rent is going to be that much, how do I know? Like just ask someone else who has nothing to do with the deal and has no skin in the game and can tell you the real truth.
So, sounds great. Well, really appreciate everyone's time. Yeah, I put, hope it's okay. I put everyone's kind of LinkedIn links in the chat. So, feel free, please, lots and lots of great, just very smart people. And so please, connect with them, super nice folks. And Jimmy, want to, wish you safe travels and sounds like a heck of a trip. So hope you and your wife have fun there.
Thank you. And I wanted to thank you and Hayden for having this panel, hosting us. Morgan and Linda, I really enjoyed kind of getting a chance to hear you talk and get to know you a little bit. And hopefully we get a chance to collaborate down the road.
Absolutely.
And thank you,
Yeah.
Morgan, for the book recommendations.
Oh, you'll enjoy that one. Thanks, guys, for being here. Really fun
Yeah.
Thanks,
panel.
everyone, for inviting us.
Appreciate it. Take care. See you
Thanks,
guys.
guys.